On the 5th of February, Strategy CEO Phong Lei gave investors a number that sent a chill down the spine of the entire crypto market. He said Bitcoin would need to fall to $8,000 before the company faced a critical failure point on its debt. Now, on the surface, that sounds reassuring. $8,000 is miles away from where we are today. But here's the uncomfortable truth. Strategy, the company that pioneered the Bitcoin Treasury model, is currently underwater on its massive bet. With an average purchase price of over $76,000 per coin and Bitcoin trading in the $60,000 range, the buffer is gone. And they aren't alone. Dozens of copycat companies that followed Michael Saylor into the breach are now sitting on massive unrealized losses. The digital asset treasury sector is facing its biggest stress test since the model was invented. And if these dominoes start to fall, the selling pressure could be unlike anything we've seen before. So, is the corporate treasury model broken? Are we looking at a cascading liquidation event that could push Bitcoin to the Stone Age? Or is it just a healthy shakeout of the weak hands? And that is exactly what we are going to be diving into today. My name is Nick, and you're watching The Coin Bureau. First things first, let's look at the elephant in the room. Strategy, formerly known as MicroStrategy. As of mid-February 2026, Strategy holds a staggering 717,131 Bitcoin. That is roughly 3.4% of every Bitcoin that will ever exist. They acquired this stack for a total cost of about $54.5 billion, which puts their average purchase price at approximately $76,027 per coin. Now, with Bitcoin recently trading between $66,000 and $68,000, that means the world's largest corporate Bitcoin holder is officially underwater. They are sitting on an unrealized loss of nearly $6 billion. But the headline that grabbed everyone's attention wasn't the unrealized loss. It was the $8,000 figure they mentioned during their Q4 earnings call. CEO Phong Lei stated that if Bitcoin were to drop to $8,000, the value of their Bitcoin reserve would roughly equal their net debt. At that point, the maths breaks down. But, well, what does that actually mean? To understand this risk, you have to look under the hood of their debt structure. Strategy has accumulated about $8.2 billion in convertible senior notes. Now, this is where things get a bit technical, so listen carefully. Unlike a margin loan you take out on a crypto exchange, these convertible notes do not have a traditional liquidation price. They are unsecured, and that means Bitcoin is unencumbered. No one can force Strategy to sell its Bitcoin just because the price drops below their cost basis. The $8,000 figure is a theoretical solvency floor, not a liquidation trigger. Basically, at $8,000 per coin, their 717,000 Bitcoin would be worth about $5.7 billion, which is roughly equal to their net debt after you account for their cash reserves. So Strategy isn't going to get a margin call tomorrow, but that doesn't mean that they are out of the woods. The real danger lies in the calendar. The first major hurdle comes in September 2027. That is when holders of over $1 billion in convertible notes can demand cash repayment if the stock price isn't performing. If Bitcoin is languishing in a bear market at that time, Strategy can't just print more shares to pay them off without diluting shareholders into oblivion. They would need cash, and to get cash, they might need to sell some Bitcoin. And remember, Strategy has obligations. They have roughly $888 million a year in interest and dividend payments to service. Sure, they have $2.25 billion cash reserves right now, which buys them about 2.5 years of runway. But if we enter into a prolonged crypto winter, that runway starts to look a lot shorter. There is a caveat here though, and that is that Michael Saylor came out a few days ago and said that the long-term plan is to, quote, equitize that debt over time. And this could reduce the risk of debt exceeding the size of the available Bitcoin. But while Strategy has a fortress balance sheet designed to weather the storm, the same cannot be said for the copycats. You see, Strategy's success spawned a legion of imitators. In 2025 alone, public companies added nearly 500,000 Bitcoin to their balance sheets. But many of these players are smaller, less capitalized, and far more vulnerable. Take BitMine immersion, for example. BitMine pivoted hard into an Ethereum treasury strategy, accumulating over 4 million ETH. But their timing was, well, let's just say it wasn't ideal. With an average cost price of around $3,800 per ETH and prices dropping significantly below that, they are sitting on unrealized losses estimated to be over $7.9 billion. That is a massive hole in the balance sheet, and unlike Strategy, which has a legacy software business generating cash, many of these copycat firms are pure play crypto bets. If their assets drop, their equity value evaporates, and their ability to raise money to service their debt vanishes. And we are already seeing the smart money head for the exits. Just a few days ago, on the 17th of February, filings revealed that billionaire investor Peter Thiel and his founders fund fully exited their position in ETHZilla. They sold everything. Now, when one of the smartest macro investors in the world dumps his entire stake in a digital asset treasury firm, it sends a signal. It suggests that the easy money phase of the treasury trade is over. And it gets worse. Galaxy Digital recently warned in their annual report that 5 or more of these digital asset treasury companies are at a high risk of a failure or forced liquidation. And this brings us to the systemic risk. The nightmare scenario isn't just one company failing, it's the contagion. And speaking of staying ahead of contagion and market risks, you need to be where the news breaks first. The Coin Bureau Telegram channel is where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates, all pinged directly to your device so you don't miss a thing. Whether it's Peter Thiel selling out of a digital treasury company or a new regulatory crackdown, our members knew about it first. So, sign up today using the link down below or by scanning this QR code over here. Now, back to the risks. We are looking at a dual threat to Bitcoin's price, a demand shock and a supply shock. First, the demand side. For the last 2 years, these corporate treasuries have been a massive source of buying pressure. Strategy alone bought 41,000 Bitcoin in January 2026. If these companies stop buying because their stock prices are tanking and they can't raise capital, that is a huge chunk of demand that just vanishes. Second, the supply side, and this is the scary part. If companies like BitMine or the smaller players identified by Galaxy Digital run out of cash, they become forced sellers. It creates a feedback loop. Prices drop, companies get margin called or they need the cash. They sell Bitcoin, prices drop further, and further companies get margin called or need the cash. We've already seen this movie play out before. We saw it with Luna, we saw it with Three Arrows Capital. Forced sellers don't care about chart support levels. They sell because they have to. And we'd already seen signs of this. On-chain data shows that Marathon Holdings, another major player, recently moved about 1,400 Bitcoin to exchange wallets. Now, moving to an exchange wallet doesn't mean that they're automatically going to sell, but it usually means they want the option to sell. So, is it a time to panic? Are we heading to $8,000? To be blunt, almost certainly not, and here's why. The $8,000 scenario is absurd. The average production cost for a Bitcoin right now, just the electricity, is estimated between $40,000 and $87,000 depending on the miner's efficiency. If Bitcoin fell to $8,000, it would be trading at a 90% discount to its production cost. The entire global mining network would shut down overnight. It would be a catastrophic failure of the network incentives that has never happened in history. Furthermore, the institutional floor is much higher than people think. BlackRock's IBIT ETF alone holds over $54 billion in Bitcoin. Sovereign wealth funds are buying, pension funds are buying. These players are not momentum traders using 100x leverage. They are allocating for the next decade. If Bitcoin were to drop to $30,000, let alone $8,000, the institutional capital on the sidelines would likely step in aggressively. So, what is actually happening? We are likely witnessing a healthy consolidation. The treasury model isn't broken, but the copycat model is. In 2025, it was just too easy. Any company could just buy some coins and watch their stock pump. That was a bubble. Now that bubble is deflating. The undercapitalized players, the ones who bought high with bad debt, they're the ones that are going to get washed out. And frankly, that is good for the ecosystem. It transfers Bitcoin from weak hands, companies that bought it for marketing purposes, to the strong hands, like long-term institutional holders. Strategy, with its unencumbered coins and massive cash runway, will likely survive, even if their stock price takes a beating. They have prepared for this. The tourists, they have not. So while headlines about $8,000 and insolvency are scary, they are largely noise. The risk is real for specific companies that over-leveraged, but for Bitcoin itself, this is just another Tuesday. But what do you think? Is the Treasury model a ticking time bomb, or is Michael Saylor a genius playing 4D chess? Let us know your thoughts in the comments down below. And if you want to understand more about the mining dynamics protecting the price floor, check out our video on that right over here. And if you want to see who is actually buying this dip, check out that video right over here. Okay, thank you all very much for watching, and I'll see you again soon. This is Nick, signing off.